Thank you, everyone. It's great to be here. A pleasure to be back at the Casey Summit. It's one of my favorite audiences as I do these presentations around the world, just because not only because there's some fair number of like-minded individuals, but the quality of the questions and the dialogue and things we get to discuss on the side are excellent. So, very happy to be here. My subject today is currency wars, the making of the next global crisis. People say, well, this is a commodities conference, it's a metals conference, it's a mining conference, it's a lot of things. What is the role of currencies in that? But I like to say, if you're a little fish, you might have to worry about the big fish. And if you're a big fish, you might have to worry about the great white shark. But all the fish, including the great white shark, worry about the ocean. And the currencies are, in effect, the ocean in which every other transaction takes place. It doesn't matter whether you're seller or buyer, you like commodities, stocks, bonds, any type of financial transaction or commodity transaction, it's always going to be denominated in some currency. And so the currencies of the environment, or as I say, the ocean in which everything else is analyzed and studied. And sometimes the ocean is calm. Sometimes we're in periods of stability, low volatility, not too many difficulties in terms of currencies, but occasionally we get into these currency wars where the environment becomes much more hostile, much more difficult to navigate. I think we're in one of those now, and that's what the focus of the presentation today. So what is a currency war? What are we talking about when we go through this analysis? It's very simple. A currency war is an effort by one country to improve its economy by devaluing its currency, in effect, to steal growth from its trading partners. There's nothing more to it than that. So, for example, like say, if you live in a small town and there are 4 stores and they all sell more or less the same thing, and one of those stores has a half-off sale, well, everyone's going to go to the place with the half-off sale. That's pretty obvious. Well, it's no different in global trade. There are a certain number of countries that manufacture aircraft. The United States has Boeing, Europe has Airbus, Brazil has Embraer, China has an aircraft industry that's developing. There are other countries that need aircraft but don't have an indigenous aircraft industry. So Thailand and Indonesia would be examples of that. So if you're Indonesian, you need some planes, you go shopping around the world. Well, if we've managed to cheapen the dollar, really lower the exchange value of the dollar, those Boeing aircraft are going to be on sale relative to the other competing aircraft manufacturers. Well, apply that to everything. General Electric wind turbines, Microsoft software, Hollywood films, books, etc., or services or vacations or whatever good or service you want to identify. That's the basic idea. And so you say, okay, gee, we can cheapen our currency. We can sell more of those Boeing aircrafts. That adds to net exports, so reduces our deficit. That improves our GDP, creates jobs. We have an unemployment problem in this country. What's wrong with that? So when the politicians look at it, they say, this is great. We expand the economy. We create jobs. We reduce unemployment. What's not to like? Let's go cheapen the currency. It sounds good, and that is the temptation for politicians. The problem is there's a lot not to like. There's a lot wrong with the scenario I just described. The first one is the United States does not operate in a vacuum. If we could unilaterally cheapen our currency and nothing else would happen, that might even work for a short period of time. But that's not the world we live in. Other countries fight back. They try to cheapen their currencies as well, and that gets us into these competitive devaluations. That's what the currency wars are all about. But it's not just cheapening your currency. You can slap on an excise tax on imported goods. This is exactly what President Nixon did in 1971. So you say, I've got a deficit, a current account deficit. I can't cheapen my currency right away, or at least not as fast as I want, so I'll put on a 10% excise tax on imported goods. That's exactly the same economically as cheapening your currency by 10%. That's how currency wars very quickly morph into trade wars, or even worse. Or a country can put on capital controls. We've seen this in Brazil and Switzerland recently. Brazil was the loser in the currency wars because they have the strongest currency in the world. It's sort of, it's like golf where a lower score is better. In a currency war, you win by having the cheapest currency. So Brazil was suffering from that. Their exports were getting killed. Their tourism was declining. So they said any hot money coming into Brazil, it used to be that you get 1 month deposits, 3 months deposits. On the shorter term deposits, they've now imposed a surtax on those to discourage the hot money. If you can still get your money into Brazil, but you have to leave it there for a long period of time. So whether it's capital controls, excise taxes, competitive devaluations, trade wars, these are all the bad effects of a currency war once you start going down that path. But there's another one. I think it's even more insidious and maybe more interesting to this group, which is inflation. People love to increase U.S. exports. They forget that we import more than we export. So if you're cheapening the currency, you're increasing the cost of those imports. We all like our iPhones and our iPads, our flat screen TVs, our Italian vacations or Argentinian vacations, as the case may be. All those things become more expensive when we have a cheaper currency. And that inflation feeds into the supply chain, feeds into the economy. And by the way, that is exactly what's intended. That's exactly why the Fed is pursuing this currency devaluation policy, because they want inflation. We'll come back to that in a few minutes. So the bottom line is, it sounds good. The superficial first order case is very compelling. It's why people are tempted into it time and time again, even though these things have ended badly in the past. It's why politicians like it. Going back to our videotape at the beginning of the session, there is really no difference between Obama and Romney on this issue. Romney is a staunch currency warrior. He wants to bash the Chinese and their so-called currency manipulation more than Obama. There's no greater currency manipulator in the world than the United States, by the way. Chinese do manipulate their currency. Everybody does. It's a policy tool. It's no different than interest rates or tax rates or budget deficits or any other policy tool that you might glom onto. But nobody does it better than the United States. And so it's a little bit like the pot calling the aluminum frying pan black. But so you won't see much difference between Obama and Romney on that particular issue. So that's the kind of political frame and the dynamic within which we're operating.